Welcome to our Taking Stock video for the week ending the 22nd of September 2023. I'm Matthew Swartz, a Senior Portfolio Manager here at Lincoln, and we're going to do a deep dive into all things share market today. And to help me do that, I'm thrilled to be joined by our Equity Analyst Daniel Ortisi. Welcome, Dan.
Yeah, good to be here, Swartz. A bit of a shaky week and one we'll address for sure going forward.
But first, a quick reminder, the information we provide during this episode is of a general nature and should not be taken as personal advice. Remember, shares are volatile and any charts or tables we present should not be relied upon as a guide for future performance. Okay, with that out the way, US markets have obviously retreated in the last couple of sessions following the Federal Reserve's decision to leave rates on hold at about 5.5%. Now, from my vantage point, there wasn't a huge amount of difference in their statement of policy compared to any of the previous meetings this year, and Jerome Powell's rhetoric during the Q&A session didn't alter all that much. However, Dan, despite what seemed to be a business as usual event, investors thought otherwise and markets proceeded to sell off quite markedly after the Fed meeting, and this did spill over into Asia and Australia with big moves down.
Yeah, exactly. They did, Matt. And we believe the reason for this can be found perhaps in examining the changes in the Federal Reserve dot plots. So surprisingly, 12 out of the 19 officials favoured another rate hike this year. And for reference, the dot plot is simply a chart that shows you where each Federal Reserve member thinks interest rates will be in the current year, 2 consecutive years after, and the more ambiguous longer run.
Yeah, Dan, and it wasn't only the short-term projection of one more hike this year that spooked investors, but also the pretty wide dispersion in estimates for the appropriate level of the federal funds rate as we push out into 2025 and beyond. And to us, this demonstrates a very wide divergence in views on inflation, the macroeconomy, amongst the governors within the Federal Reserve Bank. And this does validate our concerns within the fund team about the uncertain environment we are heading into for earnings over the next 12 months. And also, without doubt, the sudden surge in oil prices over the last couple of months is adding to the inflation uncertainty ahead, isn't it, Dan? And we do know that the Brent oil prices are edging towards that $100 US dollars a barrel.
Yeah, definitely hit the nail on the head with the rising oil price, Matt. And certainly, this may throw a spanner in the works for monetary policies going forward. For example, the RBA's current forecasts really are based on a Brent crude price of around $80 a barrel. But if we look at the current spot market, obviously that's pricing closer to 95 right now.
Yeah, that it is. Do you reckon that is temporary, or do you believe it could be more persistent?
It's a good question, Matt, and potentially the million-dollar question going forward. What we have noticed is that the recent surge is likely attributed to several factors, but a large one is certainly the export curbs by major players such as Saudi Arabia and Russia, as well as we're seeing potentially changing supply and demand dynamics. Now, the shift appears evident on this chart that we're displaying on screen, and you can note that especially over 2022, supply of oil was really a major driver of the price. That was mainly due to the Russian conflict, which disrupted global supply chains. And we also note that the most recent data point suggests supply is now contributing again, outranking demand when it comes to the fluctuations in oil prices.
And in addition to inflation and interest rate trajectories, higher energy prices will have an impact on energy-reliant industries. For example, airline carrier Qantas, its shares appear to be reacting to concerns regarding rising fuel costs, which will pressure earnings margins in the very near term.
In addition, if we look at the oil and gas sectors themselves, this could obviously present an opportunity if energy prices remain elevated. So we are currently reassessing our view of Woodside and Santos, as well as considering other potential opportunities in the sector. So definitely stay tuned for further updates from the research team.
That we will do, Dan. So moving on to Star Stock News. It's been a nasty old time for us long-term ResMed holders, with the price volatility continuing this week as the narrative around the new weight loss miracle treatment continues to spook ResMed holders. Our colleague Jason Yin released a pretty intriguing note about the rise of GLP-1 drugs, which were originally designed to help treat diabetes, but it is becoming now very commonly used off-label for weight loss management.
Yeah, and of course, Matt, given that obesity is a causal factor for obstructive sleep apnea or OSA diagnosis, the concern for ResMed is that a decline in obesity may mean fewer OSA cases going forward. Now, the market's knee-jerk reactions are really fascinating, and it seems to imply that this weight loss pill is almost some type of silver bullet for the company's future earnings. We do believe the reaction potentially may be a bit too harsh, given treatments aren't permanent, and the prohibitive cost of around $10,000 per annum US does make it slightly inaccessible for many users, which means ResMed's market may very well remain unchanged or materially unchanged going forward.
Spot on, Dan. And don't forget the potential side effects, as there is no such thing as a free lunch when it comes to pharmaceuticals. I do pardon the pun there. From our perspective, ResMed remains a quality company, and its recent share price sell down appears more of an impulsive market reaction than a reflection of the company's long-term prospects in the face of evolving medical treatments. So let's turn our attention to some emerging opportunities. Dan, what's on your radar?
Yeah, well, Matt, the company we're highlighting on the smaller end of the market this week is Silk Logistic Holdings. And to provide some context, the company provides warehousing, wharf cartage, distribution and supply chain services across the country, serving a diverse range of customers, more so in the defensive areas such as fast-moving consumer goods, agriculture, and as well as bulk materials.
But the shares have been sold off due to the market's concerns around the level of operating leverage within the business. So this essentially means that if distribution volumes do fall, Silk may experience a crunch in its net profit margins as they have less flexibility in controlling their costs. So if revenues start falling, the impact on the bottom line will be exacerbated.
That's right. Certainly that's what the market's predications are. However, our analyst Charlie has really dug deep into the recent report and believes that Silk's management team does have sufficient levers to manage some of these pressures. However, mostly as the company utilizes subcontractors rather than permanent employees, particularly in the truck driving. And this has some control over the cost of machinery as well via purchase and hire agreements rather than purchasing them themselves directly.
Additionally, Dan, we like to see multiple periods of satisfactory financial health since the company has listed Golden Rule 1. And the CEO has skin in the game, owning 13% of shares on issue. The outlook under Golden Rule 3 signals continued EPS growth. However, with only 2 covering analysts, the outlook can be less reliable.
Not to mention, Matt, as well, liquidity can be another factor to consider with only around 100,000 in daily trade. But on the balance, we believe the stock could represent an opportunity for members that are looking to add a little bit more risk to their portfolios. And now moving over to the corporate calendar, it looks like it's going to be another relatively quiet week ahead with no star stocks reporting, of course, just passing reporting season. However, we do have Suncorp hosting its AGM on the upcoming Tuesday.
And in Under the Microscope this week, we take a look at recent entrant into the star growth universe, RPMGlobal. Dan, could you take us through the thesis for the stock and why we decided to initiate when we did?
Yeah, sure thing, Matt. Well, RPMGlobal, it certainly has a long history operating as a consultant to the mining industry, and recently it's transitioned its business around over the past decade to provide software solutions that are deployed both at the mine site and also in the control room for mining companies. Given the company's expertise within the industry, they have been able to acquire and develop software packages that are quickly becoming industry standard. Now, 9 out of the 10 largest mining companies in the world have adopted at least one of RPM's products.
And we can see that the return on equity in financial year 23 was below the hurdle rates we typically look for. So is there a reason we have decided to initiate coverage relatively early on the company's software transition?
Yeah, very valid question here, Matt. And as we know, the downturn in economic conditions has meant that it's been a little bit difficult to uncover new opportunities this reporting season. So we really have been endeavoring to identify more of these emerging opportunities for our members. And furthermore, as mentioned in my initiation commentary, we do believe the real return to the business are somewhat obfuscated by the low margin advisory revenue generated, which is still around 33% of the group's total. The transition away from one-off license sales to a SaaS model is also impacting near-term returns. Over time, we certainly anticipate that return on equity and also net profit margins will improve considerably. And that's also due to the continuation of the higher margin SaaS revenue growth.
And you can see the improvement under Golden Rule 3, whereby the forecast return on equity is set to double over the next couple of years. However, we only have one covering analyst. Can we place much confidence in these figures, Dan?
Yeah, well, with only one covering analyst, Matt, the forecast certainly will be highly volatile. However, RPM was one of the few companies to actually provide earnings guidance for FY24, which does give us slightly more confidence on its near-term outlook. Additionally, the reported total contract value, or TCV for short, is sitting at around $130 million, which effectively means that RPM has signed up new clients and revenue is locked in. It's just yet to be recognized. So the pipeline, or TCV, should support that growth comfortably within the next few periods. And as mentioned previously, of course, that revenue will be higher margin than some of the existing advisory revenue.
And lastly, taking a look at Golden Rule 7, do we believe that there is sufficient skin in the game?
Yeah, if we look at CEO Richard Matthews, he does hold around 3.6% of the company, and he's been a key driver of the software development transition at RPM. So we do believe there is moderate skin in the game for this company.
In question of the week, I want to recast our focus back on the yield curve and why its shape has traditionally been a good signal for markets. So this week's question of the week is, what is the yield curve and what does it signal when it is inverted? So the yield curve is a graphical representation of interest rates for bonds with different maturities. It depicts how the market is currently pricing these bonds. A normal yield curve slopes upward, which means that investors will receive high per annum yields for bonds with longer dated maturities. We call this a normal slope because investors should seek extra return as a reward for taking on the added risk associated with tying up your money for longer periods. This is what is referred to often as term premium. But the yield curve is not normally shaped at the moment, is it, Dan?
Yeah, it's exactly right, Matt. And it's something we're currently in a period where investors aren't being rewarded for long-term premium, as you mentioned. That really means that investors believe at some point in the next 12 months, central banks will begin cutting interest rates. As depicted in the chart on screen, where we take the 10-year bond yield and deduct the 2-year bond yield, when the yield is negative, it's historically been a signal of a looming recession.
Right, and this inversion doesn't just remain an abstract concept. It has real-world implications. For instance, banks may become far more cautious about extending credit in these environments. And this is largely a function of the fact that banks typically borrow money at the short end of the curve through wholesale market instruments and term deposits, which typically have short maturities. But their loan books, as we all know, when you think about mortgages, for example, have very long maturities and are typically priced off the 10-year treasury yields.
So clearly, if the longer end of the yield is yielding less, then the banks have less incentive to take the risk of making new loans because their profit margins will, of course, be squeezed. This is but one example of why curve inversion could be a warning signal for risk assets such as equities.
Yeah, it should be, Dan, but so far this year, especially in the US, the opposite has happened, and stocks, particularly within that tech sector, have pretty much bolted. And this is all predicated on a growing belief that this time is different and we will avoid an economic slowdown, which is often referred to as the soft landing or Goldilocks scenario.
And it really does start to raise the question of whether or not we are starting to see a bubble forming within equity markets. But I guess that's what makes these financial landscapes so intriguing. You know, the interplay between bonds, equities, and broader economic indicators is always in flux, offering both challenges and opportunities for investors.
Very, very true, Dan. But we at the Lincoln Managed Funds have adopted a very cautious view. Rather than rest on our laurels and hope that the market's enthusiasm for a soft landing do eventuate, we have hedged the downside risk to all of our portfolios. And if you'd like more information about Lincoln Funds or our strategies, please speak to one of our business development managers. All right, so that's all we have time for this week. Clearly, the volatility train has left the station. So now it's more important than ever that our clients do take control over their portfolios. Dan, it's been a pleasure. Thanks for stopping by today.
Yeah, great episode, I reckon, this week, Matt, and always great to be on with you.
And for those of you that have any questions on today's episodes or just in stocks in general, please come along to our Lincoln Live webinar on Monday with myself, Tim Lincoln, Chief Investment Officer and founder of the business, Rob Manfrey, our technical expert, and with Ken away on holidays over in Darwin, Dan will be joining us also for Lincoln Live. Have a happy, healthy, prosperous week ahead. And of course, go the Mighty Blue Baggers. Take care.